Good day, students. Once again, this is another record material for cost and management accounting, and this is based on standard costing, where I will be doing income statement, budgeted and actual. Then after I do the reconciliation of the two statements, the budgeted and the actual income statement. Now let me bring your attention to what is required so that we can see what I'm talking about. It says that I should prepare the income statement in columnar form or in the format of the column, and I should show the actual budgeted profit, actual and the budgeted profit, meaning both of the profit should be shown, actual and the budgeted profit. Then after, I am required to prepare the statement of variances, which reconciles the actual profit to the budgeted profit. So now this is the major part where the most of the marks are honestly allocated. The compiling of the two income statement, budget and actual, there's not that much weight of marks, but obviously that will lead us to the reconciliation. Not to say we should not be doing that, but gist of the marks are with the analysis of the variance, reconciling the two financial statements. So now this is what we are required to do. Then let me read the information provided to us. Then we analyze accordingly and we respond to the question. It says Campo LTD operates a standard absorption costing system. Very important to highlight the fact that they are using absorption. Remember, there are two methods of compiling income statement in the cost and management accounting subject. It could be the marginal income statement. You should be familiar with this at this level. There's marginal income statement and there's also absorption income statement. And we know that marginal income statement does not take into account fixed cost in the calculation of the production cost or cost of the product. But absorption income statement take into account the fixed cost. So now this company is using absorption costing, meaning when we are compiling the two income statements, budgeted and actual, we will have to say sales minus cost of sales, because cost of sales include all the production cost, meaning the fixed cost and the variable cost. But if it was marginal income statement or standard marginal costing system, therefore now we're going to say sales minus variable production cost. So now let me perhaps try as time progresses to have a video on the marginal standard costing system. And they say in terms of which all stock, not some stock, very important, and this is written bold, all stocks or inventory are valued at standard cost, meaning when we do the budget for the budgeted production or the budgeted income statement and the actual income statement, all of our inventory should be at standard cost, not at actual versus the standard. And you'll see the impact of that when we compile our variance. The standard figures for its production as WIMP or known as WIMPA, which is the product, are as follows. So now we are given the standard information in which all stock, take note, this standard information, this is the one in which all stocks should be valued at, because they said all stock is valued at standard cost. Then after, we are given the standard information per unit of WIMPA being our product. We have the selling price, this product being sold at 80 Rand. We have direct material information, which is 22 Rand per unit, but it's made of 2 kgs per unit, meaning these are the required standard kgs to complete 1 unit of our product WIMPA. Then the kgs are standard bought at 11 Rand per kg from the supplier. That is the standard price per kg of material when we purchase it from the supplier. Direct labor is 1.5 hours to complete 1 unit at 10 rand, in which employees are paid per hour, and meaning the cost of labor per unit of Wimper will give us an amount of 15 rand, being the number of hours it takes to complete 1 unit. Multiply that by the rate per hour, that gives us 15 rand. Our variable overheads is 1.5 hours, 1.5 hours with an S there, at 12 rand per hour, and that will give us 3 rand. Therefore, now that means we take the variable overhead hours, we multiply this by 12 rand, and it gives us 3 rand. I think there should be some correction with regard to that. That will be at 2 rand, not 3 rand. So that is at 2 rand, multiply that by the rate per hour, then that will give us 3 rand instead of 12 rand. Then now we proceed on that same note. Just take note of that adjustment, that it is 2 rand per hour for the variable overheads. Then after, we have fixed production overheads, and that is 10 rand, meaning our fixed overhead is based on production, meaning the fixed overheads are absorbed based on the number of units that are manufactured, but the variable overheads are based on the number of direct labor hours that have been spent. So these overheads are absorbed using the different cost drivers. Then now we go to the next part that says standard gross profit. Remember, the standard gross profit will be the selling price minus the total cost, and our total cost, let us calculate it. It is per unit 22 rand plus 15 rand plus 3 rand plus 10 rand. This will give us 50 rand, and 50 rand will be the absorption cost per unit. This will be our cost per unit, absorption cost per unit being 50 rand. Then we say 50 rand minus the selling price of 80 rand, then that gives us 30 rand. This is where the 30 rand is coming from. It is the absorption cost per unit minus the selling price per unit, and that comes to an amount of 30 rand. That is already provided to us. Sometimes you might be required to calculate the standard gross profit per unit. So when you are required to do so, you must know that is your selling price minus the total cost, which is absorption cost of 50 rand. Then the difference will give you the standard gross profit of 30 rand in this scenario. Then after, we come to the second one, that, or the next paragraph, that says for the month of May, the budgeted production of Wimper was 10,200 units. This is what they budgeted to manufacture, and which was 2,200 more units than the budgeted sales, meaning the budgeted sales in terms of units will be the difference between 10,200 minus 2,200, meaning our budgeted sales units is expected to be an amount of 8,000 units that the company is budgeting or budgeted to sell. So now, if we do have our budgeted sales, and we also do have our selling price, meaning the sales value amount in total will be 8,000 times by 80 rand, meaning it will give us 640,000 rands as our budgeted sales value for the given month that we are doing the budget for, being the month of May. Then after, we still compile all of this when we do the income statement. This difference in units reflect management's goal of building up some stocks in anticipation of increased demand. So now that is the reason why the production is bigger than the budgeted or expected sales. There were no stocks of finished goods at 1st of May 2017, but 4,000 kgs of direct raw material was on hand at this date. So now there is no opening inventory of finished goods. We only have our production minus our sales. That will give us a production minus 2.2. That will give us our sales, meaning there will be some sorts of closing inventory. in terms of what we budgeted, because the difference between 10,000 and the amount of sales being 8,000 will give us closing of 2,200 units. So this 2.2 will be our closing inventory of finished goods. Take note of that. Then we did not have any opening, but we'll have the closing in terms of budget. Then 4,000 kgs of raw material were on hand, meaning this was an opening inventory of raw material as 4,000 units. Don't forget that this opening kgs will have to be valued at standard cost, because that is the policy of the company. The company said all stocks are valued at standard cost, meaning the cost of the opening raw material being the 4,000 will be multiplied by the standard cost per kg. That will give us the opening cost of material, but we'll also dwell on that as we progress further. Then now it says in the next paragraph that there were no opening and no closing, and no opening or closing of work in process existed for the month. So now there was no opening and no closing of inventory that was in process. Remember, in the production scenario, we have inventory of raw material, we have inventory of work in process, and we have inventory of finished goods. There are three types of inventory that we can have. But in this case, they say the inventory of work in process is not there in the month that we are dealing with. That means at least -1 calculation. Then below it says the actual profit. The actual meaning the information provided here is the actual information. We have done the standards and we budgeted based on our standard values. Then we come to the actual figures. The actual profit for the month of May was based on the following results. We have our sales, and our sales are 7,000 units, and they amounted to 567,000 rands in total. That is the total sales amount. It's not the selling price per unit, because our budgeted selling price or our standard selling price per unit was 80 rand. So obviously the actual selling price cannot be far away from the standard selling price. So obviously, meaning the 567,000 rands becomes the total sales value for the 7,000 units that were sold. But the question is, how much is the selling price per unit? So now we have to look for the selling price per unit. How much did we sell each of the units that we budgeted to sell or we actually sold? 567,000 rands is the total divided by the number of units that were sold. Therefore, now this gives us 81 rand per unit. Remember, we anticipated that we'll sell our product Wimper at 80 rand, but now we are selling it at 81 rand. So now we can see that this variance is already favorable variance. So now meaning it will be 81 rand minus 80 rand times by our sales of 7,000 units. Then we can see that there's already a variance of 7,000 for our sales. That is a favorable variance. Then now we go to the next analysis of information. The next analysis of information say that the production of 9.5 units. Remember, we are under actual. So now this is the actual production. The production of 9,500 units and associated cost were as follows. Remember, this is what we actually produced and this is what we actually sold. So now meaning we produced 9,500 but we only sold 7,000, meaning there will be a difference of 2,500. That will be part and parcel of our closing inventory. So now that will be the cost of our closing inventory. Remember, once again, this is actual 2.5 units closing inventory. Don't forget that highlighted two words. All stocks are valued at standard cost, meaning the closing inventory, meaning our actual closing inventory will have to be valued at standard cost, and our standard cost of production is an amount of 50 rand being the standard cost of 50 rand, adding all the cost including the fixed cost per unit. So now the value of the closing inventory, though it is actual inventory, but it will be valued at 50 rand. So now we need to be very mindful of that. That part was very crucial, and I will continuously remind you of other parts that will be affected by that statement. Direct raw material purchased was 16,000 kgs and it amounted to 192,000 rands. Then we need to know how much was the cost per kg. Cost per kg. If we bought 16,000 kgs and the total was 192,000, therefore now we take the total of 192,000 rands, we divide that by the total number of kgs, and this gives us an amount of 12 rand. Now, this also again becomes a very crucial variance with regards to the compiling of the income statement and also the statement stated above and the reconciliation. And I'll explain that as I progress further. Now, if we look at our standard material is 11 rand per kg. And our actual material, it is 12 rand per kg. In terms of the price of a material, meaning we'll say standard price minus actual price, times this by actual quantity purchased. So now our standard price, we can see that's 11 rand. Actual price is 12 rand. Times this by 16,000 kgs of material, actual quantities that were bought. Now, meaning the variance here will be times by 16,000. It will give us an unfavorable variance of 16,000 rands. This will be unfavorable. But the fact that this variance is unfavorable does not mean that it will apply when we do the reconciliation. Why will this not be necessary? Because our stock is not valued at the actual price. We still have the variance in terms of how much we anticipated to pay for the material and how much we actually paid for the material. But we will not be recording our material cost because the material, it is inventory, it is stock. Remember, all stock is valued at standard cost, meaning we will not be taking our actual material cost, multiplying it by 12 rand, but we'll multiply it by the standard cost of 11 rand when we are calculating the cost of the material that was used, or the cost of the material, yes, that was used into the production department, or the cost of the material that contributed to the units that were manufactured in the current year. It will be calculated at 11 rand. So now, meaning our budgeted material cost will be at 11 rand, and our actual material cost will be at 11 rand, meaning in terms of the income statement, in line with this statement, there will be no variance regarding the price of the material. And this is very crucial, honestly. I'll emphasize again as I progress with this question. Very crucial to note that stock is valued as standard cost, not only finished goods, but including the raw material, because raw material, it is stock or inventory. But the variance will still remain as 16,000, but the variance will not be done in the scenario of the reconciliation, meaning when you do the variance responding to the second requirement to prepare the statement of variance, the variance of material being 16,000 will not be done. Why are we not doing it? Because our standard price is 11. Our actual price, remember, it has to be 11 because all materials are valued at standard cost. So there will be no variance in the income statement. Therefore, when we reconcile, there will also be no variance. Then now let me proceed on that same note. Then now it's further says that direct material that was issued to production. We issued 18,000 kgs of material. Remember, we only bought 16,000 kgs of material, but there must have been some material that would have been available for us to do so. So now we issued the 18,000 kgs of material, and issuing these kgs, then the question is now, how much will be the total cost of the 18,000 kgs of material? So now that will be where is our main focus. Then now remember our stock is valued at standard cost. So now we will not be taking that and we multiply by 12 rand, because 12 rand is the actual cost, not the standard cost. So now that is why this will be multiplied by the total of the 11 rand, and this will give us the cost of the material that was issued to the production department. Times this by 18,000, and this becomes 198,000 in total. So this will be the material that must have been used in the production department in the current period as actual material used in the production. Then we proceed on that same note. Then we go to the next part where they give us the direct labor. Our direct labor hours are given to us, and our direct labor hours are 148,000, or 15,000 hours total will give us 148,500, meaning we need to know the rate per hour. How much was the actual rate that our employees were paid for? It will be 148,500. We divide that by the actual total labor hours, and it will be 9 rand 90 cents. Then now we have to say the actual labor rate of 9 rand 90 cents, vice versa the standard labor rate. Therefore now that will give us a favorable variance of the difference between the two. Then after we multiply that by the hours that are actual hours, 15,000 hours. Then now we go to the next one. Let me just say that standard hours is 10, actual hours 9 rand 90 cents, times this by actual hours, and our actual hours is 15,000. Therefore this will be minus 10, and we multiply this by 15,000 hours, meaning we'll have a variance of 1,500, being an unfavorable variance in terms of the, or favorable variance in terms of the direct labor, because we spent actually less than what we anticipated. Now we go to the next one, which is the production overheads. We have variable overheads 131,200 and fixed overheads 107,000, and we need not to do anything, but here we need to know how much is our actual overhead cost per labor hour. Why am I saying per labor hour? Because my variable overhead was based on labor hours, hence I was given here 1.5 per labor hour. Therefore now I need to say this is my actual cost in total. I need to divide it by the actual labor hours, and my actual labor hours is 15,000 hours. Therefore now this will give me the actual of 31,200. Divide this by 15,000, meaning I get 2 rand 8 cents as the actual variable overhead per hour, or per labor hour, as 2 rand 8 cents. Then I have to compare this with the standard variable overheads. My standard variable overhead was 2 rand. If you still remember, there we had 2 rand after the adjustment of that one that was mistakenly recorded. Therefore now it will be 2 rand 8 cents minus 2 rand, meaning the variance will be unfavorable by 0.08, and we have to multiply this by the actual labor hours being 15,000 hours. Therefore now there will be 1,200 of the variance regarding the variable overhead rate as 1.2. Fixed is 107,000. We just need to check how much is our budgeted fixed overheads in total. Our budgeted fixed overhead was given as 10 rand, and they said fixed production, meaning the fixed overhead was based on the number of units that were manufactured. So now I can say 10 rand times this by 10,200 budgeted production, and this will give me my budgeted fixed overheads as 10 rand times by 10,200, and this gives me 102,000 rands. And I have seen already that my actual overheads is 107,000. Then I can say minus 107,000, and I can say that there will be unfavorable variance. We have 102,000 minus 107,000. The difference is 5,000, being an unfavorable variance in terms of our fixed overheads. So now this is the info that we are provided, and we are required to do the budgeted and the actual income statement. So now let me continue with compiling these two income statements. Then after I do the reconciliation immediately after that. Then now we compile the income statement, budgeted and actual income statement, using the absorption standard costing system. Budgeted and actual income statement. You can specify and say absorption income statement. Then we will have two columns, budgeted. Then after, another column will be actual. We know that we start with the amount of sales, and we already knew that our sales here will be 640,000. Let us go and check where this 640,000 coming from. We said that the selling price is budgeted to be 80 rands, and our sales are budgeted to be an amount of 8,000 units, because we produced 10.2, which was higher by 2.2 from what we budgeted to sell. So now 8,000 units is the budgeted sales, and we multiplied those two, and we said 80 times by 8,000, it gave us 640,000. Our actual sales were given in total already as 567,000 rands. So now we copy that and we paste as 567,000 rands being our total actual sales. Then we have to say less cost of sales. And remember, when I say less cost of sales, I'm saying this because of the information that was provided to me, where I was told that the company is using absorption costing, not marginal. If it was marginal, I will have to say minus manufacturing overheads variable, or minus variable production overheads. But they are using absorption, therefore now I need to account for the fixed cost. Then I less my cost of sales. My cost of sales is made of opening inventory plus production. Then my production is divided into 3, meaning is divided into direct material, divided into direct labor, divided into variable overheads, then after I will have my fixed overheads, meaning fixed cost. That's what I'm talking about. And my fixed cost, I know that, okay, let me start with the opening. There was no opening that was given with this regard or regarding this exercise. So now if there was no, remember this is opening finished goods. I want to make that one clear. This is opening of finished goods. And also material, our production regarding material. Here material, we also can be able to say opening material plus purchases minus closing, in order for us to know how much material was used into production. If there's opening material, there's purchases and there's closing, and the cost is not the same scenario where it is based on standard costing. Therefore now that will be necessary for us to do such calculations. But for this one, they said all stocks are valued at standard cost. So now under our opening, there was no opening inventory of finished goods, but we know that there was material that was used into production. Now let me go and check how much material was used into production in terms of budget and in terms of actual. Now when it comes to the budgeted aspect, we had 10,200 units. They did not give us the actual kgs that were budgeted kgs for these units. So now we know that we manufactured 10,200 units, and the cost and the required kgs for these units is 2 kgs. So now meaning the required kgs to manufacture 10.2 units will be 2 times by 10,200, meaning we needed to budget 20,400 kgs of material in order to manufacture 10,200 units, because each unit requires 2 kgs for it to be completed. So now this is 20,400 and the standard cost per unit is 11 rand. Therefore now we say 20,400 multiply this by 11, it gives us 224,000 as our budgeted material. Therefore now we go under our budgeted material, then we record 224,000 rands as the accurate figure. Then let's go to the actual material that was issued or used into production. Material issued or used into production, we had 18,000 kgs of material that were used into production. So now if we had this 18,000 of material that was used into production, therefore now it again raises the question, how can we only buy 16,000 but we issue 18,000? The reason is because it says there were no stock of finished goods at the beginning of this. This is the actual stock now. They say there was no actual stock, though it's not under the real actual aspect. But they say, but 4,000 kgs of direct material was on hand. So now we did have material that was actually available on hand, meaning now we have to say our opening of 4,000 plus purchases of 16,000, it gives us 22,000 kgs of material that is available. So now that 22,000 which is available, we say minus 18,000, and if we minus 18,000 we are left with 2,000, meaning 2,000 becomes the closing inventory of raw material. We'll come to that very quickly. But material that was used or issued to production was 18,000. Remember, it is valued at standard cost, and which we calculated that to be 198,000. Where is that coming from? We multiplied it by 11. Why are we using 11 rand, not the actual 12 rand? Because all stocks are valued at standard cost. So now that is why we don't say the 18,000 multiply this by 12, because the purchase price of material was actually 12 rand, but we don't multiply by 12 rand because all stock, meaning all inventory, is valued at standard cost, and the standard cost of material per kg is 11 rand. Therefore now the total will give us 198,000 as our actual of 198,000 rands actual material used. Our direct labor, remember, when it comes to labor, we don't use labor is not stock, it is the cost of labor. So now when it comes to labor, that statement does not apply. We use the standard where it is budgeted, and after we use the actual where it is the actual. Let me start with the actual because I'm already here. My actual information, there is the direct labor. It is 148,500 labor that was actually incurred. Budgeted, it is 148,500. I record this as it is. Then I go to, that was my actual. Then I go to my budgeted. This is 148,500. Then I go now to my budgeted and check how much labor cost was supposed to be budgeted in order to manufacture the 10,200 units. My labor cost per unit is 15 rand. And how many units do I want to manufacture? 10,200. So now my cost of labor will be 15 rand. Multiply this by 10,200 units. 15 rand, remember, is per unit. So now this gives me 153,000 rands as my budgeted labor cost. 153,000 rands. Then I'll proceed in that same note. And remember, sometimes you might not be given this 15 rand. And when this 15 rand is not given, it also means that they might decide not to give you the budgeted units, but they can give you the budgeted hours. Therefore, now you deal with the hours and go to units, or you just use the hours. What do I mean by that? Remember, we know that it takes 1.5 hours to complete one unit. So now if you say 1.5 hours times by 10,200 units, that will give us 15,300 budgeted hours. Then now when we are given the budgeted hours and you are not given this 15 rand of the labor cost, then you can take the budgeted hours, you multiply by the rate per hour being 10 rand, you multiply this by 10, you still get to the same 153,000 rands. Therefore, now you then have to say 15,000 hours budgeted, divide this by 1.5, then this will give you the production that you need. Divide this by 1.5, which is the labor hours it takes to complete one unit. It will be 15,300. 15,300, divide this by 1.5, you'll get to the 10,200. So now this can be given honestly in different ways. That's what I'm trying to emphasize to you. Then we go to our variable overheads. Then after we go to fixed overheads. Variable overheads, we start with the budget. Then after we go to actual. Our variable overheads budgeted are given per unit once again. So now I'm not going to be repeating the same application I did with the direct labor. Our variable overheads is 3 rand per unit. And if it's 3 rand per unit, how many units do we budget to manufacture? 10,200 units. So now 10,200 units, multiply this by 3, it gives 30,600 rands. So now that will be my budgeted overheads variable. Budgeted overheads variable 30,600. Actual was already given in total and it was 31,200. Here is the variable actual overheads variable and the actual 31,200. So now I record that as it is give we mark 31,200. Then after now we come to fixed. Our fixed overheads, we calculated them to be 102,000 if my memory still serves me, and 107,000 was actual given to us in total. Actual fixed overheads, remember this is fixed overheads actual, this is actual information, so it's under actual 107,000. But our budgeted fixed overheads was given per unit. It was 10 rand and it was based on production, meaning the base to calculate this POR, predetermined overhead rate, was based on production. So now it's cost per unit, multiply this by the number of units. Therefore now it will be 10, just to refresh, 10 multiply this by 10,200, it is 102,000 rands that will be budgeted, which I've already recorded that 102,000 in my budgeted income statement. Therefore now we come to the closing part, closing inventory. Now if there was closing inventory, our closing inventory obviously being deducted, it is what is left. Therefore now that will give us the production cost. That will be our production cost. That will be our production cost. Now let me check my inventory that is budgeted to be left at the end of the accounting period. In terms of the budget, remember we budgeted to manufacture 10,200 and we budgeted to sell 8,000. If you remember where the 8,000 coming from, because it said we budgeted to manufacture 10.2, which was higher by 2.2 than the budgeted sales. So meaning our sales budgeted were less by 2.2 from what we budgeted to manufacture. So meaning now the difference between 10,200 and 2.2 will be our sales. Therefore now meaning we manufacture 10.2, we sell 8,000, closing inventory becomes 2.2. So that closing inventory is the budgeted closing inventory. So now remember, all stocks are valued at standard cost, and this is stock or inventory. All stock are valued at standard cost. Then the question is, this is the closing inventory. We need to know the total cost per unit standard. This is our standard cost, and our standard cost was 50 rand. 22 plus 15 plus 3 plus 10, that gave us 50 rand. So now when we're calculating the inventory at the end, it should be valued as standard cost because they said so. 2,200 multiply this by 50 rand, it gives us a total of 110,000 rands. This becomes 110,000 rands. Then we go to actual. Remember, we are calculating closing inventory. All stock budgeted and actual, they are based on standard cost. So now nothing changes. We're still going to be using the same 50 rand of the standard cost per unit. Now, how many units were left at the end of the year in terms of actual? Previously, we calculated 2,000. Where the 2,000 coming from? We have actual opening inventory. Actual opening. Our actual opening is 4,000. That is inventory that was left at the end of the year. We made some purchases, and our purchases amounted to, and remember, all of these are cages. All of them are cages. Therefore, now inventory available for use will be 22,000. And we issued 18,000. This is what was bought. We issued 18,000. Therefore, now what will be left will be a total of 4,000 kgs. This is 20, not 22, 16. So meaning the closing becomes 2,000 kgs. So now that will be 2,000 kgs. That will be the inventory of raw material left at the end of the year. And remember, this inventory is valued at standard cost. And our standard cost of material is 11 rand. Remember, this is only for material. We don't take now the 50 rand because we're only dealing with the material, not the cost of the completed unit. Then after now we have this 11 rand, which we multiply from the 2,000, then we get the total. Of material. Let me just correct myself there. I'm not dealing with the material here. I am dealing with the completed units. Yeah, that was done already. I'm dealing with the completed units, not with the material. Then completed units, we manufactured 9, yes, 9.5. We sold only 7,000. So now it's 9,500 minus 7,000. Then that will mean it will be 2,500 units that are completed, not the raw material aspect. Therefore now, meaning we have to say 2,200 times this by 50 rand, 2,500 multiply this by the cost of 50 rand, and it gives us the total of 125,000. 125,000. So now this will be how we do the calculation. And just coming little back to material again, just check if is nothing that I would have perhaps left. We are calculating the cost of what was used into or the cost of production. Material used was 16,000 and we multiply this by 11, so that is what was used. Then okay, yeah, let me bring my attention now to what I've just done previously, the mistake that I've done. When it comes to material used, I want to clarify you on the calculation I was doing. When you calculate material used is opening, of which our opening was 4,000 kgs and calculated at 11 at standard cost. So now, meaning it will be 11 times that by 4,000, then it gives me 44,000. So the opening cost of the raw material will be 44,000. Then after we say purchases, our purchases were 16,000 kgs. Remember, all valued at standard cost, so we still multiply by 11. So we say 16,000 kgs, multiply this by 11, it is 176,000. I just want to clarify you on the mistake that I was making, instead of wondering what was I doing. Then after we'll have our closing, and our closing we calculated it to be 2,000. If you remember, 2,020 minus 18, because we had 16 that was bought, 4,000 that was available, that became 20,000, and we used 18,000 kgs. So closing will be 2,000, and the 2,000 is valued at 11 rand, which is standard. So now we have 2,000 times this by 11. Then let me check. We have 11 times this by 2,000. It is 11 times by 2,000, 22,000. So we have 22,000 rands as the value of the material that was left at the end. Now, when everything is valued at standard cost, it's not necessary for us to show all this calculation when you calculate what was used. Therefore, now, when you're calculating what was used, it will then be calculated by saying opening, of which our opening is 44,000, plus production, which is 176,000, minus closing being 22,000. We get how much? 198,000 is the material that was used. So now I do not want to take it the long way in terms of how to calculate material that was used. Otherwise, where the opening is valued at a different price and purchases at a different price, then it becomes important for us to calculate it in this manner, 198,000. Where is this 198,000 coming from? We just said in our calculations 18,000 times this by 11. If you remember, 11 times this by 18,000, it gives us 198,000, which was material that was issued into production. So now I just want to clarify you in terms of the mistake of the inventory that I was calculating. So remember, it is the 198,000 that I'm referring to. It is this 198,000 of the material that was actually used into production. So now, sorry for me to explain such because of the mistake that I've made. I know some of you would have been confused. Why was I calculating material? Then why am I stopping and I'm calculating the value of the closing inventory? So I was dealing here with the finished inventory, not with the inventory that was left in terms of raw material. Therefore, now we proceed on that same note, calculating now the production cost. Then production cost will be made of material 198,000 plus 145,800 plus 31,200 plus 107,000 minus 125,000, and this gives us 357,000. This is 357,000. Then after we go to, let me just do a recalculation on that, 198,000 plus 148,500 plus 31,200 plus 107,000 minus 125,000, 197,000, 159,700, 159,700, budgeted 224,000 plus 153,000 plus 30,600 plus 102,000 minus 110,000, which gives 399,600. Just confirm again, 110,000 plus 102,000, 224,400, yes, plus 153,000 plus 30,600 plus 102,000 minus 110,000. That is 400,000. Then after sales, which is 640,000, will gives a total of 240,000. That is gross profit. Then my actual will be 567,000 minus 359,700, 207,300. So now this is my income statements, and from here now I have to compile my variance or do my variance. Then from the variance I can check if does my budget reconcile up to actual. So now we do the variance. My variance start with the sales variance, and my sales start with the price. Then when it comes to the price, I am dealing with the selling price. My selling price is the actual price of 81 rand minus the 80 rand that I budgeted times by 7,000 units. We budgeted to sell our units at 80 rand, but we actually sold them at 81 rand. If you remember, we had 81 rand here, which came from the 567,000. Divide this by 7,000, and that was 81 rand, and multiply that by actual sales. So now, meaning it will give me a variance of 7,000. Then after I go to my sales volume, and this variance is favorable. This variance is favorable. 7,000 favorable. It is favorable. We sold our inventory at a higher price than expected. My sales volume, it is the actual sales of 7,000 minus the budgeted sales of 8,000. Multiply this by the gross profit or standard gross profit. My standard gross profit was calculated to be 30 Rand. When it comes to the volume, we always use the standard gross profit. And the standard gross profit is 30 Rand. Always make sure you use 30 Rand, not the 80 Rand. Standard gross profit is 30 Rand, which is sales minus cost of sales per unit. So now we multiply this by 30 Rand and we will get to an unfavorable variance. And this unfavorable variance will be 81 minus 80 times, it will be 1000 times this by 30, and it is an amount of 30,000 rands. So the net of this variance, will be minus 7,000, then it is 23,000, and 23,000 will be unfavorable because the total of this was unfavorable, so this becomes negative. I just combined both of the variance under sales, meaning the volume and the price, sales variance. Then I go to material. Variance. Just leave some space. Material is both the price, and I am dealing with the price of material, and the price of material is standard price. Now, as I explained this before, the price of material is valued at the same amount of 11 Rand. So there will be no calculation for the price of the material variance. We only do the usage. Why? Because our material was valued at the same price. So now we'll be doing only the usage variance. Then material usage, it will be standard quantities minus actual quantities used, and actual quantities used I think was 18,000. Then multiply that by the standard price of 11 Rand. Let me just check my standard quantities. My standard quantities will be the actual production, which is 19,500, times this by the standard kgs per unit. Standard kgs per unit, it is 2 kgs per unit. Actual production of 9,000 units, multiply that by the required kgs on standard per unit. That will give me the standard material. 2 times that by 9,500, it gives me the number of kgs that were supposed to be spent. So now the company is supposed to have used 19,000 kgs, but they use 18,000. So this variance will definitely be a favorable variance. If we multiply this by 11, it will give us 11,000, and this variance is favorable. So I'll record that 11,000 here on top as favorable variance. So the total of this variance is still favorable. Then I go to the labor variance, direct labor variance, which is the rate, standard rate of 11 Rand, I think it's 10 Rand, standard rate of 10 Rand, minus actual rate of 9 Rand 90, times this by actual hours, 15,000 hours. Let me confirm those figures. My standard rate of labor is 10 Rand. I expect to pay my laborers 10 Rand per hour, but how much did I actually pay them? I paid them the total divided by the total hours. Total cost divide that by the total hours. Total cost was 148,500. Divide this by 15,000 hours. It was 9 Rand 90 cents. So now my actual hours is 15,000. So that is where the calculations are coming from. Then this will be 990 minus 10 times this by 15,000. This variance of 1.5 will be favorable. this variance will be favorable. Still have to record the second one. Then I go to the labor efficiency. My labor efficiency variance will be calculated by saying standard hours minus actual hours of 15,000 times this by the standard rate, and the standard rate being 10 rand per hour. Then let me calculate my standard hours. My standard hours will be standard hours per unit of 1.5 times this by actual production. Actual production being 9,500 units. So now this was my actual production units that were actually produced. Then I multiply that, it will give me my standard production. 9,500 multiply this by 1.5, I get 14,250 hours. I get 14,250 hours minus 15,000 times this by 10. I get 7,500, being unfavorable. Employees spend too much time than they were expected. So the net of this variance will be plus 1,500. So I will have an amount of 6,000 rands. This is unfavorable, and this is also unfavorable. So my net of my labor variance is unfavorable, and it is 6,000. Then I go to variable overheads. Variance. Again, under variable overhead, I start with the rate. Standard rate was 2 rand, and actual rate, it was 2 rand 8 cents. Term this by actual hours of 15,000, because this is based on direct labor hours. Standard rate of my variable overheads per hour was 2 rand per hour. Remember that adjustment, 2 rand per hour. Then my actual, I have to look for the actual. My actual must have been the total variable overheads of 31,200. Divide this by the actual hours to get it per hour. So it was 31,200. Divide this by 15,000 hours, and I got 2 rand 8 cents, 2.08. My actual hours is 15,000 hours of labor. Then from there we will get an unfavorable variance, minus 2 rand times this by 15,000. It is 1.2 unfavorable. 1.2 unfavorable. That will be regarded as negative. Then we go to the variable overhead efficiency, which is standard hours. Remember, standard hours, they don't change. It is still the same 14,250. Actual hours 15,000, nothing changes. Standard rate is 2 rand. Then the variance here is likely to be favorable. So now we have 14,250 minus 15,000, likely to be unfavorable. Term this by 2, thought it would be favorable. Then we have a variance of 1.5, a variable of 1.5, that is unfavorable, 1,500. And because these two variants are unfavorable, so their net will also be unfavorable, minus 1,200. So I have 2,700 of this variance being unfavorable. Then I go now to the next and the last part of my variance, fixed overhead. I go to my fixed overhead. fixed overhead. My fixed overhead is the rate, then the cost in fact, which is cost budgeted fixed cost. It was 102,000 minus actual fixed cost 107,000. The difference was 5,000, and 5,000 was unfavorable. This one is exactly from the income statement. We budgeted our fixed cost to be 102,000 and our actual 107,000, and the variance there will be 5,000, and I did calculate that before already. So that is where this variance is coming from. Very straightforward and very easy variance. Oh, there's still some space. I must record it at the bottom here. I thought it's the end. Fixed overhead, cost variance, and it will be the cost of fixed overhead budgeted 102,000 minus 107,000. There is 5,000 that is unfavorable. Then we go to volume, fixed overhead volume, and fixed overhead volume will be, if you remember, it's budgeted hours normally minus actual hours times this by the standard price. And because, or the standard rate, because we are not given the budgeted fixed overhead based on labor hours, it was based on production. Hence they said fixed production overhead. So now meaning it was based on production, meaning I need my budgeted production and my actual production. Then I multiply by the cost of 10 rand per unit. So now if this fixed overhead was based on labor hours, then I was going to be using the hours. But because of that, therefore now I will be using my budgeted units, not hours. So my budgeted units of production, it is 10,200 minus actual units of 9.5 times this by the rate of 10 rand per unit. Therefore it will be 10,200 minus 9,500 times this by 10 rand. This variance will be unfavorable because we produced less than what we anticipated. So now we'll have another unfavorable variance, and it will be times by 10. I did not multiply it yet. We have 10,200 minus 9,500. It times this by 10. I get 7,000. Okay, 7,000. So the 7,000 plus 5,000, it gives me the unfavorable total of 12,000. This is unfavorable. Now when we do the reconciliation of profit, what we do, we just say budgeted profit, which is 240,000 minus the variance, it will give us the actual profit. So now that is exactly what we'll be doing. Then we show those calculations, or let me just use this part. Then I just say budgeted profit I have my budgeted profit and my budgeted profit is 240,000. Then now I just deduct all the variants that are negative and add all those that are positive. 240,000 minus 23,000 plus 11,000 minus 6,000 plus minus 2.7 minus 12,000. This gives me 207,300. This should be the amount of the actual profit. So now the difference between the budgeted profit and the actual profit is because of the variance. Now let us confirm our actual profit. There is our actual profit 207,500. You just say budgeted profit. If you want, you can just not have the total of the variance here. You just say 240,000, just like this, 240,000 plus 7,000. You deal with them individually, minus 30,000 plus 11,000. Then you still get the same, plus 1.5 minus 7,500 minus 1,200 plus 1.5. Hope all the figures are accurate, but I will not be recalculating if I've made a mistake. Minus 5,000 minus 7,000. Some mistake have been done somewhere, but you can still calculate them individually, subtract where it's necessary, deal with this variance as individual variance. But for me, I decided to opt for the totals, and that is the best option that I always prefer and recommend. So now with that, let me say thank you guys. Hope you have understood that. Bye bye.